It's Monday, November 3rd, 2025, and I'm Dave Soap. 3 things to know today. AI spending hits stratospheric levels as Google, Microsoft, and Amazon pour hundreds of billions into cloud and data center expansion. Analysts warn the boom could turn frothy if returns lag. Insurers bet big on AI, with 67% expecting payoffs within 3 years, while telecoms accelerate cloud adoption to support automation. And small business sales are up 8%. But inflation and tariffs squeeze margins, with corporate refugees driving demand for essential service businesses. Here's what that means for IT providers navigating both the AI surge and Main Street shifts. This is the business of tech. It's My Markets Monday, and let's start with the earnings reports from last week. Alphabet has increased its projected capital expenditures for the year to between $91 billion and $93 billion, driven by strong demand for artificial intelligence. The company reported quarterly revenue of $102.35 billion, surpassing analyst expectations of $99.89 billion, with a notable 34% growth in cloud revenue, which reached $15.16 billion. CEO Sundar Pichai emphasized the company's commitment to investing in customer demand and seizing growth opportunities. Despite concerns about a potential AI bubble, Alphabet's advertising revenue also rose by 12.6% to $74.18 billion, alleviating investor fears regarding the digital ad market's stability among economic uncertainties. Amazon has reported a 20% increase in revenue for its cloud computing division, Amazon Web Services, despite that global outage that disrupted numerous services. The company exceeded Wall Street's expectations, generating $33 billion in net sales for the third quarter, compared to an anticipated $32.42 billion. CEO Andy Jassy stated that AWS is experiencing its strongest growth since 2022, highlighting the resilience of its cloud services amid increasing competition from providers like Google Cloud and Microsoft Azure. Jassy clarified during the earnings call that layoffs of 14,000 corporate jobs were not financially or artificially driven, stating it's culture, and emphasizing the need for a leaner organizational structure to enhance decision-making and ownership among employees. In addition, AWS's operating income rose to $11.4 billion, up from $10.4 billion year over year. The company continues to invest heavily in artificial intelligence and infrastructure, with total capital expenditures expected to reach $125 billion by the end of the year. Microsoft has reported a significant $49 billion in cloud revenue, despite facing capacity shortages that are expected to persist throughout fiscal 2026. During their earnings call, CEO Satya Nadella highlighted that Azure revenue grew by 40% year over year, indicating strong demand for its cloud services. In addition to the revenue figures, Microsoft reported that its artificial intelligence offerings have attracted approximately 900 million monthly active users, with the Copilot tools alone reaching 150 million users. Despite these successes, Microsoft's Chief Financial Officer, Amy Hood, noted that the ongoing capacity constraints could have limited revenue potential. The company has invested nearly $35 billion in capital expenditures this quarter to enhance its infrastructure, but these efforts have not yet alleviated the supply issues affecting Azure services. And Microsoft's latest earnings report indicates that OpenAI experienced a staggering net loss of $11.5 billion in the quarter ending September 30th, 2025. This loss did impact significantly Microsoft's financials, leading to a $3.1 billion increase in net income and a reduction of 0.41 in diluted earnings per share. Microsoft, which has invested a total of $13 billion in OpenAI and holds a 27% stake, uses equity accounting to reflect its share of OpenAI's losses directly in its financial statements. Why do we care? AI infrastructure spending is exploding. Google, Microsoft, Amazon, and Meta have all increased their capital investment plans, with total spending set to top $300 billion by the end of 2025. Much of that is going into data centers and GPU capacity to meet AI demand. Analysts warn that this level of debt-fueled expansion could create risks if AI doesn't deliver expected returns, though the Federal Reserve points out that today's firms are far more profitable than those in the dot-com era. Meanwhile, other sectors are jumping in. A KPMG survey shows 67% of insurance CEOs expect AI returns within 3 years, up from just 20% last year. And telecoms are rapidly modernizing their networks, with public cloud use for network workloads projected to quadruple by 2030. For providers, this environment means both opportunity and volatility. AI is driving infrastructure upgrades, but costs and capacity limits could ripple downstream. The winners will be the providers who can help clients evaluate where AI fits financially and operationally, not just technically. This episode is brought to you by Control Map. Growing MSPs are using Control Map to build recurring revenue by expanding their GRC services. Starting now, Control Map is offering a free plan for MSPs looking to get started with providing compliance as a service. Create a free account and run an assessment. Track key items like policies, risks, and evidence in one place. It's a practical way to prove value to a client before deciding to expand your compliance offering. Try Control Map for free today. Visit scalepad.com/Dave to get started. That's scalepad.com/Dave. So let's put those earnings reports in some context. The New York Times reports on the accelerating spending on artificial intelligence by major technology companies, raising concerns of a potential bubble in the industry. Companies like Google, Meta, Microsoft, and Amazon reported substantial increases in their investments, with Google planning to spend an additional $6 billion on AI data centers this year, following nearly $64 billion spent over the past 9 months. Microsoft also revealed a quarterly expenditure of $35 billion, $5 billion more than previously expected, while Meta's forecast increased to at least $70 billion for the year, almost double their prior spending. As these companies invest heavily in data centers to meet growing demand, the Bank of England warns that increasing reliance on debt for these developments poses a risk if AI fails to deliver anticipated returns. Federal Reserve Chair Jerome Powell noted that current investments differ from the dot-com boom, stating that the leading firms now have strong earnings and established business models. However, smaller companies in the sector, which lack similar financial backing, may face greater challenges as they also pursue AI projects. A recent KPMG survey reveals that 67% of insurance CEOs believe they will see returns from artificial intelligence investments within 1 to 3 years, a significant increase from just 20% last year. The CEO of Travelers emphasized the company's commitment to AI, stating they are investing over $1.5 billion annually in technology, with a focus on AI to enhance operational efficiency. The survey included 110 insurance CEOs and found that 73% prioritize AI investments, reflecting a broader trend across industries where 71% of CEOs recognize AI as a critical investment area. However, 77% of insurance CEOs expressed concerns that regulatory lag could hinder their success in adopting AI technologies. Global spending on telecommunications network cloud infrastructure and software is set to increase from $17.4 billion in 2025 to $24.8 billion by 2030, reflecting a compound annual growth rate of 7.3%. According to Omdia's recent report, the acceleration of cloud adoption among communication service providers is expected to reach 12% growth in 2025, doubling the previous year's rate. One of the senior analysts at Omdia noted that telecommunications companies are modernizing their infrastructure to support both cloud-native network functions and AI-driven key automation. Key trends include a significant shift toward public cloud adoption for network workloads, with usage projected to rise from 3% in 2024 to 13% by 2030, and a growing emphasis on artificial intelligence capabilities in cloud infrastructure decisions. Why do we care? So here's the thing. AI isn't just a software story anymore. It's an infrastructure story. Google, Microsoft, Amazon, and Meta are all going all in on a spending spree. We're talking hundreds of billions of dollars building data centers and grabbing GPUs. That's a lot of money betting that AI actually pays off. And sure, these giants can afford it, but smaller players, not so much. The Bank of England's already warning about too much debt tied up in the build-out. And while Fed Chair Powell says this isn't another dot-com bubble, it still feels a little frothy. Meanwhile, CEOs everywhere, especially in industries like insurance, are suddenly convinced AI will pay off in just a couple of years. That's optimistic. For IT service providers, this is the time to help clients stay grounded. Costs will rise, capacity will stay tight, and not every AI bet will win. The real opportunity? Be the one who helps clients figure out when AI makes sense and when it's just hype with a cloud bill attached. Because in this gold rush, the ones selling the picks and maps, not just the shovels, are going to win. Small business sales are experiencing a notable surge, with completed transactions rising to 2,599 in the third quarter of 2025, an 8% increase from the previous year, according to BizBuySell's Q3 2025 Insight Report. Despite this growth in deal activity, owner confidence has declined, falling below neutral on the Buyer-Sell Confidence Index due to ongoing inflation and rising operational costs. Over half of small business owners report higher expenses related to tariffs, and 62% indicate that inflationary pressures have not eased. Amidst these challenges, 55% of business owners believe they can achieve their desired sale price now, while 60% worry that waiting could yield lower offers. The median sale price has decreased to $320,044, reflecting a 2% drop year over year, as higher costs are eroding profitability for sellers. Interestingly, many buyers are motivated by a desire for autonomy, with 40% identified as corporate refugees, looking for new opportunities in essential service sectors like HVAC, plumbing, and landscaping. As the market remains competitive, brokers advise sellers to focus on readiness rather than market conditions. Why do we care? So small business sales are up, but don't mistake that for everyone getting rich. The latest BizBuySell report shows deals up 8%, but confidence is down, and sales prices are actually slipping a bit. Inflation, tariffs, and higher costs are squeezing margins, so a lot of owners are selling now before things get worse. Here's a twist. Buyers aren't venture types. They're corporate refugees, folks leaving big business to buy stable service businesses like HVAC and plumbing. That's where it gets interesting for IT providers. These buyers need tech setups fast, phone, scheduling, billing, cybersecurity, but they're not experts. They want reliable, predictable systems. That's all an entry point. Offer startup-friendly packages that make running the business easier without big overhead. Now, if you're an MSP owner thinking of your own exit, this report's a reminder. Valuations depend on documentation, contracts, and margin discipline. The market's moving, but it's a buyer's game now. This episode is supported by FlexPoint. Looking to ditch Connect Booster or legacy payment tools that slow you down? FlexPoint is the independent billing and payments platform purpose-built for managed service providers. With fast QuickBooks syncing, branded portals, credit card fee pass-through, and automated subscription billing, FlexPoint streamlines invoicing without locking you into contracts. Clients get financing options. You get faster cash flow, less manual work, and full control, without the bloat or uncertainty tied to big acquisitions. Trusted by MSPs as a Connect Booster alternative that listens and delivers, FlexPoint is built to serve, not to scale for someone else's exit. Schedule a demo now at getflexpoint.com/MSP-radio. Thanks for listening. Today, National Sandwich Day, one I think we can all agree on. Want more from the Business of Tech? Join Business of Tech Plus for ad-free episodes, early interviews, extended cuts, subscriber-only shows, and exclusive member perks and analysis. Sign up at businessof.tech/plus. And follow this show in your podcast app, and if you're on YouTube, hit subscribe and the bell so you never miss a story. Reviews and comments help spread the word too. Interested in advertising? Head to mspradio.com/engage. The Business of Tech is written and produced by me, Dave Sobel, under ethics guidelines posted at businessof.tech. Thanks for listening. I'll see you on the next episode.
Part of the MSP Radio Network.